Here, let's do a quick check of the markets. We're about 90 minutes into the trading day. There you're taking a look at some mixed activity. The Dow Jones Industrial Average up by about 0.25%. S&P 500, that is down, flat, just barely to the downside right now. And the NASDAQ, you're seeing that flat, just barely to the downside as well. So losing some steam after weaker than expected consumer confidence data. The decline, the largest in more than 3 years, according to the conference board here. We will note that the cutoff data for the preliminary results, that was September 17th. What happened then? Yeah, that was right before the Fed's decision to cut rates by 50 basis points. Here to dig into the numbers and the market reaction, we've got Burns McKinney, NFJ Investment Group, Managing Director and Senior Portfolio Manager here. Burns, great to have you here with us this morning. First, just take us into what the consumer read-through is more broadly. It's come up as part of the inflationary picture as well from Fed Governor Michelle Bowman earlier here this morning as we got those remarks, and then now continuing to try and get a sense of where consumers and how consumers are doing battling up against inflation.
Sure. And today's consumer confidence numbers were a bit weaker than expected. They were down. I think it's instructive to note that one of the key reasons for that has a lot to do with inflation, that not necessarily the inflation we're seeing today or yesterday, but really just a buildup of higher prices over the last 2 and 3 years, as well as the fact that we do have signs of job weakness. That said, I think it's also instructive for investors to note that whereas the unemployment rate has risen from 3.5% to 4.2%, you really need to dig into why it's been rising. And it hasn't necessarily been rising because of people being laid off as much as it has that more entrance into the workplace. And likewise, we're not quite seeing as many additions as we had during the sharp comeback from the pandemic. And so, Jay Powell noted last week that although the economy and labor is softening, but it still remains fairly strong.
When you hear quotes like this from the chief economist of the conference board saying September's decline was the largest since August of 2021 and all 5 components of the index deteriorated, how does that impact the investment thesis around the consumer right now?
Well, the first thing that we like to tell our clients is, we definitely always caution against reading too much into one data point. We really prefer, smooth things out and look at, really where the trends lie. And, the consumer has continued to be fairly strong. That said, you also have a situation where, from an investor standpoint, valuations have gotten rich enough that any softness you do see could lead to possibly more muted returns going forward.
So with that in mind, part of your thesis here is despite the recent rally that we've seen, you say we should expect volatility ahead. To what extent? I mean, we're not getting back to early August volatility levels, right?
No, nothing like we've seen there. But at the same time, you still do have enough factors, enough uncertainty in the markets that could drive higher volatility. First and foremost, we do have a very uncertain election coming up in the next 5, 6, 6, 7 weeks. And on top of there being uncertainty around the election, there's just uncertainty as far as whether we're even going to know who won that election on the day after. So between that, there's still geopolitical situations, in Europe, in the Middle East. And so volatility should remain somewhat elevated. That's one reason why we've been focusing a lot on places like dividend-paying stocks. Those are the type of the names that, whenever, capital gains go up and down or stock prices go up and down, the dividend component of return is the one thing that adds a little bit of stability to client portfolios.
Certainly. And then with that in mind, some of the companies that have been most in focus have really been annexed to this theme of artificial intelligence to this juncture in the run-up over the past year and change. When we've seen past rate cutting cycles, tech has been one of the beneficiaries. Do you expect that to be the same? And how much more legs, perhaps, does the AI trade have with that in mind and hoping that maybe history either repeats itself or at least rhymes a little bit?
Well, yeah, the key theme to this bull market has been the AI trade. That said, one of the things that we expect to see going forward, really specifically now that the Fed has begun its rate cutting cycle, is a little bit of a broadening of those gains, a sharing of the wealth, if you will, to places that do tend to do well when the Fed cuts rates, specifically if they cut rates, not necessarily out of weakness, but out of a position of strength. They're not necessarily reducing rates to stave off an imminent recession, but rather simply because the inflation adjusted rate, as inflation has really pulled back, has gotten a bit restrictive. And so when you see central bankers making cuts in these instances, it does tend to lead to gains in some of these other places in addition to tech. Places like cyclicals often do well, value stocks do well, some of the banks, as well as perhaps stocks overseas.
We certainly do enjoy some sharing of the wealth. Of course, that largely the ethos behind this show. Burns McKinney, who's the NFJ Investment Group Managing Director. Thanks for taking the time here with us today.
Thanks for having me.
Certainly.